All right. Well, thanks for joining, guys. This is our first monthly webinar, what we're planning on doing on a monthly basis. Over the last year, really our only communication has been through the quarterly letters, as well as if you guys reached out or if I reached out to you. And so we thought that having more back and forth around what's going on in the fund would be helpful to you, and I enjoy doing it. So let me just get to the most entertaining element of the presentation quickly here. And that is our legal disclaimer. I'm not going to read this out to you guys, but need to have the legal disclaimer before we go into different elements about the portfolio. And I will send this presentation out after sometime later today or later this week. And this will also be recorded, so you'll be able to review it in the future. Other administrative elements is this is a time where if you have any questions for me, please send me an email and I would love to address it here. Or if you have questions that you want to talk about later, you can also send it to that email as well. But throughout this presentation, if there's anything you have a question on, just shoot me an email so I can answer it. All right, now to the more interesting part, the part that's actually very, very interesting, and that is what we're seeing today. So as you all know, 2022 was a difficult year for growth investors. And between the war in Ukraine, interest rates increasing dramatically, and everyone's aversion away from growth-oriented companies, there were a lot of companies that we held that had to pivot their cost structures and get onto steady footing before they can grow again. And I think the thing that we're so excited about right now over the first 5 months of the year is we've really been seeing really strong results, and that the restructurings we've seen that were executed in 2022 are now really starting to come to fruition, which is getting me very excited for getting to the other side of this market turmoil, because our businesses are going to have much leaner cost structures, and when growth returns, incremental margins are going to explode. That is going to be a very large pivot from people's current perception of a lot of our holdings, which people have viewed as unprofitable, low quality businesses, which are anything but that. So if there's one takeaway from this webinar, it should be that the way things are tracking this year are very exciting and going in a direction that I'm personally very excited about. I'll run through the aggregate portfolio today and talk about the risk reward that we see across our different holdings. That's just like creating an enormous investment opportunity. When I talk about 5 to 10 times investment opportunity over 5 years, people often think it sounds a bit aggressive. Understandably, it's not common that you see that type of investment performance, but in moments like we're in today is when they happen. So if we look back into 0809, if we look back into the COVID pandemic, if we look back to 2002, small mid-cap growth-oriented companies get, like, everyone sells them in moments of panic. Even if they're a phenomenal business, even if the opportunity is enormous over the next 5 to 10 years, they get tossed into this short-term risk bucket, and it can create tremendous investment opportunities. And I articulated that in several of my letters. Companies like Priceline went in 0809 went from $140 to $50. 5 years later was $1,000. Lululemon went from $20 to $2. 5 years later, it's over $50. Domino's Pizza went from $30, I think, to $3. 5 years later, it was over $50. So the idea that there are 5 to 10x return opportunities today is not. It's like we've seen this before in similar scenarios where no one is interested in small mid-cap growth companies. And lastly, an update that I wanted to provide was, as many of you know, we had a founders class which had favorable pricing for our unit holders the first year of launch, and we decided to extend that for another year, so till March 1st of 2024. All right, let's get into first just an overview of the strategy, so that we're familiarized with exactly the mission that we're on, what Optimist Fund is all about. So every single day I wake up thinking about Optimist Fund's mission, which is betting on exceptional people with exceptional growth opportunities to produce world-class long-term investment returns. That is what I'm always thinking about as my North Star. And why that is important is that it really focuses what the fund is about. There are a lot of different strategies that can do a lot of different things. You could be focused on turnarounds. You could be focused on dividend producing assets. You could be focused on great companies and trading opportunities. That's not the way we view things. We are like incredibly focused on what we do, which is only focusing on businesses where we think the people are exceptional, the growth opportunity is exceptional, which we believe will drive long-term exceptional investment returns. So what is the definition of exceptional to us? So on the people element, unfortunately, it is qualitative, but it really is about a track record of the company, of the management team that's running the company. So it's not so much that there's like a bar of, you have to have built this size of company to be deemed an exceptional CEO. Ultimately, we're looking at what is the CEO done? Is it highly unusual, the success that he's had? And has he proven an ability to create material shareholder wealth? That is ultimately like the qualitative answer. The more important element about having exceptional people be part of the mission is that it's what it keeps us from doing. It's that if we think the management team is not exceptional, or there's many situations you could say this is a very cheap asset with a 5 out of 10 management team, that often can be an investment opportunity for many people. That is not what we're going to do. If we think it's a 5 out of 10 management team, but it's an incredibly cheap asset, we're going to move on from that investment or have a path to moving on from that investment. On the exceptional growth opportunities, we view that as 10% free cash flow growth 10 years from now. Do we think this business has enough growth opportunity that 10 years from now they could be growing free cash flow 10% plus? So that it really centers on this business needs to either have a huge market opportunity with significant organic growth runway, or they need to be a very high quality acquirer of businesses that can always find new areas to grow. And then lastly, the long-term investment returns we define as the S&P 500 has compounded around 10% over the last 100 years. And so we plan to do better than that over a 5-year interval. That is the goal. That is the real nuts and bolts of everything that we're focused on every single day, is delivering against that. And so our portfolio today is mostly founder-led management teams or CEOs that are very similar to founders and that have been there, have built the strategy for a long period of time. That is the majority of the portfolio today, and that's what I would expect the majority of the portfolio to be forever. The philosophy, how we are different: growth-oriented value investors. So we are value investors that are always looking to find undervalued cash flow streams, but we focus on high growth companies. A lot of value investors focus on lower growth companies that are generating cash today. Our area of focus are businesses that we think can generate significantly more cash over the next 10 years, but they might not be generating as much cash today. So we have to focus and really understand what the unit economics are and the quality of that business to ensure that the cash flow we think is going to happen in the future, in fact, happens. We're absolute return focused. To keep a long-term approach, that's critical to the type of companies that we look for. We're concentrated. We have 15 to 25 names, and volatility is opportunity, not risk. Risk to us is actually being wrong on the investment thesis around what cash generation this business can generate over the next 5 years, not whether or not the stock is highly volatile. That actually is what creates significant opportunity and part of the reason why we're so excited right now. All right, so then just to get us back to then the 5 things that we focus on. It's management, market, moat, unit economics, valuation. Management, you can probably understand from what I just said. Ambitious and proven management teams. Market, large market opportunity enabling material long-term growth. The moat has to be strong because you can't compound at above average rates for a very long time if your competitive advantage doesn't exist. Competition will enter and they will erode your moat. The biggest differentiator here, I would say, in the 5 that could be different than a lot of other funds that you look at is unit economics. Unit economics is what drives long-term profitability, but unit economics could be very strong, but profitability could look very weak. For example, if you're investing into acquiring new customers and it's a 2-year payback, the first year clearly you don't make money, and you break even after 2 years, and then after 3, 4, or 5 years you're highly profitable. But if you continuously redeploy that capital, your profits could be weak, but your unit economics are very strong, and thus your profit capacity, if you want to slow your growth, is very high. So that's a very key defining element of how we look at businesses. And then to valuation, everything is about discounted cash flow streams. We are only looking for companies that are significantly undervalued relative to where they're trading at today. The hurdle rate's generally 20%. But in environments like this, 20% is far too low. There's very, very attractive opportunities in this market environment. All right, so the current portfolio. So we're quite concentrated today. We have about 19 holdings, and our top 10 is just under 80% of the fund. The return potential of the fund today, again, these are think about this as like a range. When I've written in my opening letter, it's about hit rates, it's about a batting percentage. So this is a base case estimate of the fund over a 5-year period, assuming at 100% hit rate. And this is what I've written about previously. The cause for such excitement in this current market environment is largely that I could be materially off on many estimates. We could have a 50% hit rate and our returns are going to be very attractive. And I don't expect to be 50% off. So it's why the risk reward today is skewed so heavily in our favor. That just makes me so fired up about the investment opportunity, frankly. So I just wanted that was like giving the overview of the state of the fund today and just reminding everyone really the key pillars of what we do, why we do it, and how we do it. The purpose for the monthly webinars is really going to be about updates on what's happening with the fund on an ongoing basis, right? So the most topical updates currently is just our Q1 reporting season, which we've just went through. So the Q1 earnings season so far has been really good. I'm really pleased with it. Out of the entire holdings, about 70% have outperformed expectations, which was great to see, and some were just very material and drove. It just really provides incremental confidence in the bull case for some of our holdings. So why don't we start with the largest holding, Uber. So Uber, as many of you I'm sure know, use the product. has been looked at as not a good business historically because they spent so much money to build out a global infrastructure and become the Uber service. But over the last year, really, that has shifted where Uber has put in place these profit targets that they expect to hit over the next by 2024, and they have been absolutely crushing that plan. And so Uber has consistently been growing their top line, growing their bookings through the rides business, as well as the delivery business continues to grow. But what really has driven the opportunity, and what I'm excited about because it will defeat the bare thesis of it not being a highly economic business, is their margins are just exploding. So if you think about incremental margins, a really important term is how much incremental dollars flow to the bottom line of growth. So if you had a business that did $100 of revenue and it grew to 110, of that $10, how much actually flowed through to the bottom line? And so for Uber today's EBITDA as a percentage of gross bookings is about 2.5%, but on the incremental growth, it's about 12%. So on every dollar that they're growing, the margin flow through is almost 6 times what the overall business is today. And so what that's going to triangulate towards is as they keep growing, their margins are going to keep exploding. And over the next year, they're going to have to make over the next year and a half, they'll have to make a new plan because we'll be at 2024 and we'll be able to measure them against the goals that they put in place, which right now they're outperforming. But then we're gonna have to look at, okay, what's the next 5 years? And we roll that forward. That's what makes me so excited, because when I roll that forward, I see a scenario where Uber could be generating over $10 billion of free cash flow, and it's a $78 billion company today, and doing over $10 billion of free cash flow, still growing 20% a year. So that is highly, highly attractive, and it's also has so little competition and so few things that can really disrupt the business. So they are really like a monopoly, in my view, just chugging along, showing how economic the business is because they've built out this scale. So that one's going great. That one's going great. We haven't done anything with that position. It's doing what we actually better than we hoped it would do. Shifting to DoorDash. Similar thing on DoorDash. DoorDash and Uber kind of clumped into the same bucket of this irrational exuberance of spending, that they are a growth at all costs type company. And it's frankly just like not true. It's not true, but it sounds nice. Like it's someone on Wall Street Journal can write an article about it, and it drives a narrative that everyone thinks that these businesses don't care about generating shareholder wealth, but they in fact do. And DoorDash has been a very similar situation to Uber from the standpoint that they're continuously growing. DoorDash gross order value grew roughly 20% organically this quarter, after growing 24% in Q1 of last year and growing over 200% in Q1 of the year before. So like, not only did they explode in the pandemic, which everyone's well aware of, but they've kept layering on, growing more and more every year on top of that huge level of demand. It's very clear that this is not a business that is just going away from the pandemic. And then again, on that incremental margin piece. So DoorDash has been free cash flow positive, but hasn't generated a ton of free cash flow. And we're seeing a similar playbook to Uber, albeit a little less. They're showing a little less flow through than Uber, but still very attractive flow through that is going to eliminate people's view to say that this is not a rational business, that it's not economic, they don't make money. Like, those arguments aren't going to be able to be held, in my view, a few years from now, as they keep growing and the incremental margins keep flowing through like they are. And so we feel very, very good about those two positions. Shifting to two like much more contentious names is Wayfair and Carvana. So let's start with Wayfair. So Wayfair is the leader in selling home products online, as many of you know, and they had a very significant growth trajectory from when they went public to 2020. Obviously, they were very much known for being a huge beneficiary of the pandemic. Since the reopening has had a negative impact on their business, more so than they were expecting, they had too much fixed costs relative to the revenue that is actually ended up coming in. So their margins dipped to going negative after they were profitable for several years. And so the shift to Wayfair and what drove the stock price down last year was revenue coming in weaker with still a bloated cost structure, and then people getting concerned about the balance sheet of the business, the viability of the business, because if they can't generate cash, then eventually they would run out of money. This past quarter, two strong developments occurred. Number one, they beat on their profit expectations pretty significantly, which are now nearly break even for Q1, and Q2 they are going to be adjusted EBITDA profitable. And so we're getting to that point where people are going to no longer be concerned about like viability of the business, which like it is a bit nuts given, I mean, Wayfair generated over $1 billion of cash a few years ago and has been just a thriving, very strong business for a long time. But the concern really shifted towards their viability, and that is, I over the next year, it's hard for me to imagine that concern going higher because of the cost actions they've taken and the fact that they should be sustainably profitable on a go-forward basis. So that was good to see, but we still need some time. Like the first thing for Wayfair will be the profitability, which they just announced that they're going to show. But then the second thing is like getting back to robust revenue growth. And so now the revenue growth has been weaker. They still declined this past quarter, but it's largely due to the market being significantly weaker. So their US business declined 5%. The market declined near 20%. So they're gaining a lot of market share, which is beneficial. They're getting back to to positive profitability, which will relieve people's concern that it is going to have a balance sheet issue. And then as we shift through the year, the growth should come. And when that happens is when people's view of Wayfair no longer is going to be about what's the cash over the next month. It's going to be, okay, this is the leader in online home goods that is a incredibly capital efficient business that has proven unit economics, proven profitability, that has been gaining significant market share for the last 10 years. Over the next 5 years could be a double-digit top-line growth business with 5% plus free cash flow margins, which we believe will drive very material re-rating in Wayfair's share price. So we're really excited about that name and really happy with what we're seeing most recently. And then lastly, in terms of who's been outperforming expectations, it's Carvana. Carvana had a horrible perfect storm last year where they levered up to buy a business while the demand environment deteriorated, and they had a bloated cost structure because they were overbuilt, expecting material growth that didn't end up coming through. And so they had to restructure. They had to take $1 billion of cost out of their operating expense budget. And that obviously is very difficult to do and takes a lot of hard work. And the great thing about the progress on that is this past quarter, they materially outperformed the expectations on their ability to get back to break even. And so now Carvana is going to be EBITDA positive in Q2. And we believe that over the next several quarters can get to free cash flow positive as well. And when that happens, the idea that Carvana is not going to be a business will be completely eliminated, and the view will shift back to this is the second largest used car dealer in the US that didn't exist 12 years ago, gained significant share, drove to a profitable model, and now have enormous competitive advantages to continuously gain share and become the largest car dealership in the US. And so uh, after those Carvana results, we hadn't done anything with Carvana from like I hadn't been adding to it since, well, since middle of last year or something. I think it was middle of last year. I hadn't done anything with it, and just waiting to start to see some positive momentum on their cost restructurings to get more confidence that they're going to get to like free cash flow break even. And this quarter de-risks the thesis dramatically. They still have over $1.5 billion of like immediate liquidity they can draw from. They have $2 billion of real estate that they can sale lease back or get a mortgage on if they needed incremental capital, which I don't think they do. This quarter was very important for the thesis. So we added to the position shortly after the quarter because after I saw the results, I actually thought the stock should be up. Like the stock should be up 100% off of those results, but it was up like 25%. So we added to the position and really like it. Really like it a lot. It's not people do not like it, that's for sure. But we think that this is it's really like the most attractive risk reward opportunity I've come across. They have clear line of sight on what they need to do to deliver on their plan and be viewed again as an incredibly valuable asset that has so much growth runway and will be a cash machine at maturity. And they just need to execute against it. And now they've set the bar at a place where I think they're going to be able to deliver. So we'll see what's I'll keep you up to date with what's going on with Carvana clearly, but this quarter was a very positive move in the right direction. Let's shift to some companies that were either in line or missing expectations, so less strong, which typically we'll have a few each quarter. So Colliers would be the first one. The commercial real estate industry is kind of at a standstill currently because of interest rates increasing so dramatically. And so they're a transactional model, or a big piece of the business is a transactional model, which is weaker than they initially expected. So they had to lower their guidance for the year. That is very much transitory. So there's no impact to our long-term thesis. There's no part of me is losing sleep about my Colliers position at all. But it was still a tougher environment. So weaker results in the short term is what it is. But no change there. Revolve and Cricket were both in a similar camp where they are seeing more softness in their end market. And so as many of you know, like people are talking about a recession this year. Whether one happens or not, we'll see, but definitely seeing consumer spend soften. Revolve, which is an online fashion retailer, is not immune to feeling those pressures. So they have a very strong balance sheet. It's a profitable model. They have a strong business. The two founders own 45% of the company. There's no concern around their ability to navigate this environment. But when things weaken, they just need to adjust to the environment and play offense when it's time to play offense again. And then Cricket, for anyone who knows Cricket, it's a cutting machine that is connected to an app that allows you to personalize items and do different crafting projects. So if you go on Etsy, a very large percentage of Etsy's products would be made with a Cricut machine. And Cricut really created this category. They have about 95% share in cutting machines. They sell largely through channels like Target, Walmart, Michaels, and different crafting stores. And the retailers that I just named have had softer demand recently, so they have been slower to reorder reorder product from Cricket. And so Cricket's also seeing some cyclical challenges, but the business is profitable. They have a strong balance sheet. They actually are returning more capital to shareholders because since the demand environment's a little weaker, they can work down a lot of their inventory. And so they're actually just announced a special dividend where they're paying out $1 of special dividend after they did a 35-cent special in February. So they're paying out about $1.35 in the year, and it's a $9 stock. So getting mid-teens yield in the short term, but really we think that this could be a much larger business in the future as they've like cemented a category, and now just need to keep growing the category. And so sit tight with that holding. And then Peloton. So Peloton results over the last 9 months have been really promising. They've lowered their burn significantly. They've outperformed on membership ads. What has been underperforming recently is they've had a few like cockroaches come out that have impacted their ability to keep moving forward. So one would be they had this patent settlement with Dish that they had to settle, which is a $75 million outflow they have to pay in Q4. So that pushed out their ability to get to free cash flow positive when they initially wanted to because of the settlement. Then they have a new recall. I don't know if any of you guys use the product. They had a new recall that like 20 people out of, which I think it was 35 people out of 2.1 million had the seat snap, and half of those people were hurt from when the seat snapped. This happened with people who were over 5'11" and over 250 pounds. And so this was announced that they were doing this recall and that everyone was able to get a new seat if they want one. This is, I don't believe this is going to be a material event. There's going to obviously be people that reach out for it. They've already expected an $8 million incremental cost of having to ship people an incremental seat. But what we saw then the following week was finally a settlement on getting approval for the Tread. For anyone who wasn't aware, but the Tread Plus, their high-end treadmill, has not been sold for 2 years now because someone died getting pulled under the treadmill. So that has been sold for 2 years. And now that, so a few days after they announced this recall on the main bike, they announced that they've gotten approval for the fix on the Tread, and that the Tread could be sold again by the end of the year. So it seems to me that the recall on the first bike was really a way in which to be proactive and like very consumer friendly and friendly with the government to get them to move forward with the approval of the guard that they're putting at the back of the Tread Plus. So it seems like those are connected, but again, these are things where after having such a challenging last year, having to restructure their cost base, these like incremental headwinds have like slowed the momentum of people viewing the business getting back to, being a profitable model that has growth opportunity. But that being said, I don't know who's seen this recently, but they just announced their new app strategy where they're going to have a different pricing structure. So before, the app was $12.99 US, and that was how you'd use it. And now they're shifting to a model where it's a freemium strategy, a $12.99 model, and then a $24.99 model. And so what they're trying to do is make it so that every single person can use Peloton in some way, shape, or form with the freemium strategy, similar to a Spotify with their freemium strategy. And so that's a very interesting strategy that I'm excited to see what could happen from that. And then they also added a product within the app of focusing on gym workouts. And so really what they're trying to do is, they've always talked about being like a fitness company. but they really have just been predominantly a bike business. And focusing on the app to create features that can be for people that are actually going to the gym to have workouts is an interesting strategy. We'll see. We'll see how it pans out. I'm not like it's not the thesis is not dependent on that, but like no one is gaining share against Peloton. It's like the idea of being the leading fitness platform. There's nothing today that is like saying, oh, Peloton is not doing well and like these guys are going to like become what Peloton should have been. There isn't that. And so that is why I still believe in the Peloton thesis. Even though there's been a couple things that have, not been ideal, they've been pushing out the thesis slightly. From a competitive standpoint, from the value proposition of the product standpoint, it is still like, in my view, a highly, highly undervalued platform that has a lot of future opportunity. And so we're still holding it today, but definitely not happy with just these like these little incremental headwinds that they've been facing. And then lastly, we still have 3 more companies to report: Asana, Smartsheet, and Phreesia, which make up roughly 15% of the fund. Smartsheet is the second largest holding. They report in 2 weeks, roughly. And so we'll be able to talk about what's going on with that holding next month. But yeah, that's really how Q1 earnings season has gone so far. It's been really good. I'm very happy with it, and love to switch over to Q&A. If any of you have any questions, I would love to answer them. All right, let's check my email here. All right, first question here. Are you only looking for investments that have the potential to generate 5 to 10x investment returns over 5 years? No, definitely am not only looking for that. Right now is a very unique time for small mid-cap growth companies. This is not a very common situation where there's the type of opportunity that we see today. And so what I've said previously is the hurdle rate is 20%. When we're looking for a name, we're hoping for a 20% IRR over 5 years. That's roughly 150% return over 5 years. That is the baseline target on underwriting. I know that seems like very low relative to what I'm talking about, but that's purely because of what we're seeing in the environment today. But I don't expect that to last. I would think that 3 years from now we'll be talking about different return profiles than we're talking about today, because we probably won't be. Well, we might be 3 years from now. It could be another pandemic, or who knows. But there's going to be a time where we're not fearing recessions. That's inevitably going to happen, where good times are back. People are feeling optimistic. People are feeling good, and we're thinking about the long-term opportunity for companies. And when that happens, a lot of our names are going to be significantly more expensive than they are today, which is going to make much less attractive investment opportunities. Let's get another question here. All right, so question: how big are these? Yeah, so our average market cap today is 8 billion. Yeah, so the first question is, how big are the market cap of the companies that we hold? So yeah, so it's 8 billion is the average. Hold on a second. Get back to this one. Yeah, so 8 billion US is our average market cap. In terms of how big are the TAMs versus the current market share. Okay, so maybe I'll just use Uber's TAM is in the trillions of dollars because it's a transportation market, right? Like if you were to look at Uber's TAM, you would include all public transit, you'd include all people driving vehicles, like the TAM is so large that it's frankly like almost an irrelevant. I almost think it's like an irrelevant analysis because Uber really is just creating market today. But if we look at Uber today, like Uber's like around 100 billion in gross bookings. And so you look at 100 billion in gross bookings to a TAM that they would argue the mobility TAM is like several trillion, and then the delivery TAM as well is like roughly $1 trillion. And so there's definitely under 10% penetration of the opportunity that Uber has today. Like that is something that is very clear. Like let's just take the delivery business, like restaurant delivery, penetration of restaurant delivery in the entire restaurant category in the US is like around 10%, just under 10%. Then you add grocery penetrations at 5%. You had like categories like convenience, that would probably be under 2%. You had other on-demand categories like any brick and mortar store that might want to deliver something in an hour, that would be definitely under 1%. So the growth opportunity for a company like Uber and DoorDash, frankly, is very sizable. There's not, in my view, like the TAM is not something I worry about. There not being enough TAM. That's not something I worry about in my holdings. Well, definitely in those two holdings. Yeah, so Uber, let's just say Uber is the example. So Uber today, and I'm just talking about Uber so much because it's the largest holding. It's like the easiest one to, let's just keep it consistent so it's easier to follow. So we just take Uber's business today, and we assume that they can keep growing revenue in the 15 to 20% range and continue the margin flow through that they've been doing for 2 years now. 5 years time, they're going to do roughly $7 of free cash flow, and apply a 25 times multiple to that. We're going to get to like near $200. Then we add the equity stakes. They have a bunch of equity stakes in some other holdings as well, because they merged with Grab and like a few other Uber-like companies in Asia. So you have those equity stakes in, you have the cash on the balance sheet in as well, and right there you're getting to a $200 stock price. So really, like, what's the limiting factor from getting here to $200? It's that they grow revenue 15% plus. It's that their incremental margins stay the same as they, or at least what they've been. Well, they've been better recently. The incremental margins are within 70% of what they've been over the last 2 years. And that by itself will flow through to a $7 free cash flow number. And then you can question, okay, what multiple do I want to put on that? Oh, Jordan says 25 times. I think that's aggressive. I don't think 25 times it's a 25 times business. So put 15 times on that. You're going to get to an attractive return. You're going to get to a very attractive investment return. And so that's an example of just like how the math triangulates to going from where we are today, Uber's like, $38 stock, to what I believe will be over $200 stock. But even, we could sensitize that to let's get more conservative. Let's say the incrementals are 50% of what they've been, and growth is 10%, 10% instead of 15 to 20%. Like it's very difficult for me to see a scenario where Uber is not like a double-digit IRR over the next 5 years. Like it's difficult for me to envision that scenario, but it is. So that's how I'm thinking about it. Cool. Another Uber question. Here we go. What is Uber going to do with all the free cash flow they generate? Are you going to look to replace Focus Financial with another financial compounder? So on Uber, yes. So what they've said is later this year, they're going to start thinking about what to do with their incremental free cash flow because they're going to be generating so much of it. In 2024, they could generate, I think, over $4 billion in free cash flow. And so likely that's going to be shareholder return centric. My guess is it will be buybacks. That's the guess. And so, frankly, if the stock stays low and they buy back more and more shares with that incremental free cash flow, that would actually be accretive to my valuation. So that's the thing about Uber that's interesting is like Uber is viewed as like this, or it's been viewed as like this, like, oh, this is like the growth at all costs type company. It's like, no, it like they had to they built out a digital railroad across the world in like under 10 years. Like that costs a lot of money to do that and to build out this like monopoly position. And so now that they've built it out, it's just now they can really monetize it, and that's what we're about to see. And then they can do with free cash flow as as companies that generate tons of free cash flow can often do, which is return it to shareholders. I don't think they'll do M&A. Like they'll do small tuck-ins, but I don't expect them to do any sort of material M&A. On the replace Focus, yeah. So I own Focus Financial, as many of you know. Loved that company. Very, very upset that they sold. The deal hasn't gone through yet, but right now it's like $52 and the deal's $53. So it's like an arb spread that I'm not going to sit around and wait for because I would rather redeploy the capital. So I've already done that. I sold Focus. I've redeployed the capital across all my names. So I just largely equal weighted it across the existing portfolio. And I still hope that the Focus deal doesn't go through. I'm praying that the Focus deal doesn't go through because then the stock likely is going to go down on that day, and then we can buy it back and take part of the compounding opportunity that Focus Financial has. But I'm not holding my breath for it. I think I feel like people are going to accept the deal, but we'll see. Okay. So how do a lot of people are talking about AI currently? You see opportunities, including new holdings in your portfolio that are around the AI theme, or companies like Facebook, Apple, Google, or Tesla. I'm just curious how you're thinking about this new AI area. Okay, good question. So first easy question is, so I focus on global like SMID cap. So I define that as like 500 million to 50 billion market cap companies on position initiation. And so Google, Apple, Facebook, these companies are much, much larger. They're not businesses that are within my core wheelhouse. So they're not somewhere where I would spend a lot of time. So I won't be focusing on those businesses to buy. In terms of opportunities, I am so artificial intelligence is definitely going to have a very large impact on every company's product roadmap for sure, because people are going to be trying to incorporate generative AI into like anything that could be applied to their product with generative AI. They're going to be sure to figure it out and do it. Partially because it's such a buzzword right now that everyone feels like they need to do it, and partially because there's probably some scenarios where there's like value to be had in doing it. In terms of like looking for investment opportunities, I don't look for investment opportunities based on people's interest in them. I look for opportunities more based on like seeing a really high value customer use case run by a really smart capital allocator. And so like I'm not looking from a top down perspective saying like I need to like own a business that's like addressing AI. If I'm picking the right CEOs, they're going to address AI in the way that maximizes value of their business, and so that's how I think about it. Now I think that the CEOs of the companies we own are exceptional and are going to do that, but I'm not going to like start from like AI theme. Where does the idea come from? It's just not the way I find ideas. How are the efforts going finding new opportunities given how discounted the opportunity set is? Would you prefer to add additional names or swap out existing names? Will Carvana hit free cash flow break even in 2023? Okay, let's start with that question, and then we'll go to the next ones. Yeah, so I am finding some interesting opportunities, but your point is correct in that it's challenging for me to have something new come into the portfolio when companies I know so well have been following for years, um, and really like are sitting right there. It's such compelling valuations. That being said, I have added one new position. It's the first new position I've had in a year, and it's Monday.com. It's frankly, I own Smartsheet, Asana, Monday.com. They all kind of compete together in different areas of their business. But Monday is really been impressive. Their results have really been impressive. The CEO is incredibly impressive as well. And I personally love the collaborative work management space. I think it's has so much growth potential, and they're just such good businesses because they connect people around projects, and people once they use one tool, they just like don't like to switch. So they're just really sticky businesses, which allow them to earn great returns. And so what I've done with that position though, since it's not actually like overly complementary of a new exposure, I've lowered my Asana, my weight in Asana and added Monday.com. And but it's starting it out at a 2% position because I haven't been following it for 5 years like I have many of my other companies. And so I'm going to start small and build comfort, build conviction from that perspective. But yeah, it's unlikely that I'm going to also have like a new position that's like a 10 weight. That's like I don't see that happening. All right. Will Carvana hit free cash flow break even in 2023? We will see. I think it's very possible. I think it's very possible that Q4 is free cash flow break even. Um, Now, if it's Q1 of next year or Q2 of next year, it's not the end of the world. It's like they have enough capital that if it is 2 quarters later, it's fine. Like that's completely okay. But I do think it's possible to be free cash flow break even by the end of the year. Why isn't it a top position if the risk reward is the best I've ever seen? Um, So Carvana is just it's a higher risk position than an Uber, a Smartsheet, or an ACV because of the balance sheet. And so, it is a top 5 position, which is large, like it's a 7 weight. That's not a small position. Um, but do I want it to be the top position from like my own adding to it? I'll be patient. Like we added after this quarter on seeing strong results. If like Carvana, they keep executing the way they did the last quarter, there's going to be like many times to buy this company because it's not like it's all of a sudden going to be. It's not going to just happen overnight, right? Like it could go from $10 to $25, and at $25 it could be a better buy than it is today at $11 because it's de-risked. So that's how I'm thinking about it today. I think Carvana will probably end up at some point one of my largest holdings because the performance will be so strong that it'll grow to be one of the biggest positions. But that's how I'm thinking about it today. Are you worried you're too exposed to 3 somewhat similar food delivery opportunities: Uber, Dash, Just Eat Takeaway, and HelloFresh? Why not pick a favorite? Yeah, so Uber, yeah, obviously Uber has Uber Eats, which is a direct competitor with DoorDash. But Uber's rideshare business really is like the cash cow, though Eats is a good business. Um, I don't I don't feel like I'm overexposed to it because it's just such a great space that is really misunderstood today. That has enormous runway. Food is a massive category that still has very low online penetration. Like it is enormous. Um, and like generally people eat the same way they've been eating for a very long time from the standpoint that like you go to the grocery store and you walk down the when you say, oh, I need to look for cinnamon, you're running around the aisles searching for it and have no idea. And so like the shift to online, the convenience of online in food broadly, I think is just like an absolute tidal wave. And like my Just Eat Takeaway really is like I own Just Eat Takeaway is the leading player in Europe. So they have really strong positions in several countries in Europe. So my Just Eat Takeaway thesis is more own the leader in several large, own like the DoorDash of Germany, own the DoorDash of the Netherlands. So it's not like as much of a direct competitive view from my perspective. And so that's really how I've thought. And then HelloFresh does a different thing. Like HelloFresh does a different thing than the two other players that you mentioned. Like meal kits is a different business. It's a niche business. Yes, it's food, but they have like 80% market share in all their markets. They're still growing top line double digits. They have strong margins, strong return on capital. Like HelloFresh is a global monopoly that for some reason no one cares about. So I just see the risk reward on these names are just so attractive because they have such strong market positions and they're such established businesses. They're huge businesses that people are treating like they're like not good businesses. And in my view is like they're just like grocery stores. Well, in Canada, how many grocery stores are there? There's like 3 grocery stores that you go to any neighborhood and one of them's dominating that area. And someone talks about Loblaws, the other person talks about Metro, and no one's going to be like, "Oh, is Metro better than Loblaws?" Yeah, one person's going to say it, but they're largely the same. But they're a few massive businesses that like have huge distribution power that are typically one of the largest companies in a country. Like the leading grocer is typically one of the largest companies in a country. And my view is like Uber, DoorDash, like these online aggregators and Just Eat in Europe, they are going to have that type of like market structure and company size that is just so clear. Like we can just see it. If we just put on our consumer hat and just look around, we can just see dominance. But then when I hear investors talking about it, it's just like they're not talking about like how much cash can this business generate in 5 years. They're talking about like, are they paying RS, like they're paying in restricted stock or a new options plan. It's like it has not. It's just such an opportunity. So I do realize I have a big exposure there, but it's because I just think the opportunity is that attractive. Yeah. So then Jesse's asked another question on the DoorDash versus Uber on the food delivery side. How do I think about the competitive overlap between Uber and DoorDash? Yeah, so like in the US, DoorDash is the dominant player. They are 60% share. Uber's in the high 30s now. Um, I expect DoorDash to stay the leader. Uber's share composition is, having about 50% share in the metro markets and then 30% share in the suburban markets. And the suburban markets is really where there's like a lot more growth. And so that's why I struggle to see how Uber like rises above DoorDash. And I don't think they want to because of the margin targets that they've put in place. They're very happy to just be a great duopoly, keep growing, keep the categories is still growing. And if they just hold their share that they currently have, both of them are going to be able to generate tons of cash, become incredible businesses, and yeah, compete, but not to a point where it like really disrupts either's financial projection. So yeah, I'm not concerned about the overlap between the two. It's a pretty good market structure, and there's not a lot of incentive for them to all of a sudden want to get into a knife fight. So feel good about that. All right, we got one more. We have time for one more question here. Given the market shift in focus towards profitable companies, is it more likely that incremental new ideas will be favored towards profitable companies? Great question. That could happen, but that will not be an input. So profitability is not an input, it's an output of strong unit economics. So if I look at a great business that has a lot of growth opportunity, great CEO, and fantastic unit economics, and together that creates an output that is in aggregate a profitable business, that's super undervalued, that might be very attractive to me. On the other hand, it could be a business that's redeploying all of their profits into continuously going after a market opportunity at very high returns. And in that scenario, I would say, why are you showing profits? Why don't you reinvest this capital so we can have a way bigger company 5 years from now? Like I'm not going to be asking for a dividend. I want the business to be worth a lot more. And so if you have very high returning investment opportunities as a company, you should take your capital and invest it in those opportunities to create more value for shareholders over time. So the long way of saying, we'll never screen based on just like profits, but strong unit economics, and then like obviously a balance sheet that is strong enough to be able to execute against the plan they have in place. Great. Well, that is all the time we have. This is the first of many. I appreciate everyone joining the call. This is the first time I'm doing this, so it does feel a little bit strange talking to myself, but I will get better over time. And if anyone has any suggestions as to how I can provide different content that is interesting to you, that makes you have a better understanding of what I'm doing, I'm all ears. Reach out, let me know, and I'm very happy to hear from you. But with that, I will see you guys next month. Enjoy the rest of your day.